Welcome back to Bull Mindset. Have you ever taken a loss and immediately felt the urge to jump back into the market to win your money back? If so, you're not alone. In today's video, you will learn why revenge trading happens, how it silently destroys trading accounts, and most importantly, how professional traders break the cycle before it damages their confidence and consistency. Stay with me until the end, because the techniques we discuss today could save you months or even years of frustration. And if you're serious about mastering trading psychology, consider subscribing to Bull Mindset. Now, let us begin. One of the most dangerous habits in trading is not poor analysis. It is not poor strategy. It is not even poor risk management. One of the most dangerous habits is revenge trading. Because revenge trading takes a small problem and turns it into a large problem. It takes a manageable loss and transforms it into unnecessary damage. It takes discipline away from the trader and replaces it with emotion. The dangerous part is that revenge trading rarely feels irrational in the moment. In fact, it often feels completely justified. The trader believes they are simply recovering losses. The trader believes they are taking advantage of another opportunity. The trader believes they are being aggressive. But underneath those explanations is often something much deeper: emotion, frustration, anger, impatience, the desire to erase emotional pain. And this is where the cycle begins. Let us start with a simple question. Why does revenge trading happen? The answer is surprisingly simple. Human beings dislike losses, not only financially, emotionally, psychologically. A loss creates discomfort. A loss creates frustration. A loss challenges expectations. And when discomfort appears, the brain immediately starts searching for relief. This is normal human behavior. When something feels painful, we naturally want to remove the pain. In trading, the easiest way to seek relief is often another trade. The trader believes the next trade will fix everything. The trader believes the next trade will restore confidence. The trader believes the next trade will eliminate frustration. But this belief is usually an illusion, because emotional trading rarely produces rational decisions. Now let us discuss what actually happens after a losing trade. Imagine you enter a trade based on your strategy. The setup looks good. The analysis makes sense. Risk is controlled. Everything appears correct. Then the market moves against you. Your stop loss is hit. Immediately, a series of emotions can appear: disappointment, frustration, self-doubt, anger, embarrassment. The emotional reaction may be small, or it may be intense. It depends on the trader. But the emotional response exists. And this emotional response influences thinking. Instead of evaluating the next opportunity objectively, the trader begins viewing the market through the lens of frustration. This is where danger appears. Now the trader is no longer focused on process. The trader is focused on recovery. And recovery becomes the emotional goal. The market becomes secondary. The emotions become primary. Now let us discuss something important. Revenge trading is rarely about money. Most traders believe they are trying to recover money, but often they are trying to recover something else: confidence, control, certainty, pride. A loss can make traders feel as though something has been taken away from them, and they want it back immediately. This emotional urgency is what drives revenge trading. Professional traders understand this. They recognize that the strongest urge after a loss is often emotional rather than logical. And because they recognize it, they can manage it. Now let us talk about the illusion of control. This is one of the most powerful psychological traps in trading. After a loss, many traders feel as though control has been lost. The market did something unexpected. The outcome was not what they wanted. And the brain begins searching for a way to regain control. The easiest way seems to be placing another trade. Action creates the feeling of control. But feelings are not always reality. Placing another trade does not guarantee recovery. Placing another trade does not guarantee confidence. Placing another trade only creates another opportunity for risk. Professional traders understand that control exists in only a few areas. They can control risk. They can control discipline. They can control execution. They cannot control outcomes. And accepting this reality reduces emotional pressure. Now let us discuss another reason revenge trading is so common. The brain remembers pain more intensely than pleasure. Think about this carefully. Many traders experience a profitable trade and feel happy for a short period, but a losing trade can stay in their minds for hours. sometimes days, sometimes even weeks. Losses often leave a stronger emotional imprint than gains. Because of this, traders become highly motivated to eliminate the pain. Again, the market appears to offer a solution. Another trade, another opportunity, another chance. But when decisions are driven by pain avoidance, discipline often disappears. Now let us discuss emotional urgency. This concept is critical. Professional traders understand that urgency is often the enemy of good decision-making. The moment you feel like you must trade, you should become cautious. The moment you feel like you must recover losses immediately, you should become cautious. The moment you feel like you cannot wait, you should become cautious. Because urgency often signals emotional involvement, and emotional involvement often leads to poor decisions. The best trades usually emerge from patience, not urgency, from discipline, not frustration, from clarity, not emotional pressure. Now let us discuss another dangerous trap. Many traders secretly believe they deserve to win. They put time into learning. They study charts. They spend hours analyzing markets. And because of this effort, they feel entitled to positive outcomes. But markets do not reward effort. Markets reward probabilities. Sometimes excellent trades lose. Sometimes perfect setups fail. Sometimes great analysis produces negative outcomes. This reality is difficult to accept, and when traders resist accepting it, revenge trading becomes more likely. Because they feel the market has treated them unfairly, the trader begins thinking, "I deserve better than this. I should not have lost. I need to get it back." And these thoughts create emotional pressure. Now let us discuss another important truth. Every revenge trade begins with a story inside the trader's mind. The market owes me. I need to recover. I cannot finish the day negative. I need to prove myself. I need to fix this. These stories feel convincing, but they are emotional narratives, not objective analysis. Professional traders learn to recognize these stories. The moment they hear them, they become cautious, because awareness creates control, and control protects discipline. Now let us discuss the difference between amateur thinking and professional thinking. An amateur trader focuses heavily on individual outcomes. One trade, one day, one session. Everything feels important. Everything feels urgent. A professional trader thinks differently. The professional trader thinks in terms of hundreds of trades, months, years, long-term consistency. This perspective changes everything. A single loss becomes less significant. A single losing day becomes less emotional. The need for immediate recovery disappears. And when urgency disappears, revenge trading becomes less likely. Now let us talk about identity. Many traders connect their self-worth to trading results. When they win, they feel successful. When they lose, they feel inadequate. This creates emotional instability, because confidence becomes dependent on outcomes. Professional traders separate identity from results. A losing trade does not define them. A losing day does not define them. A drawdown does not define them. They evaluate themselves based on process, preparation, discipline, execution. This creates emotional stability, and emotional stability is one of the strongest defenses against revenge trading. If you are finding value in this lesson, consider subscribing to Bull Mindset, because mastering your emotions is often more important than mastering another trading strategy. Now let us discuss one final concept before moving into real-world examples. Revenge trading is not a market problem. It is an emotional regulation problem. The market simply reveals what already exists inside the trader. Impatience, frustration, fear, the inability to accept uncertainty, the inability to accept losses. And until those emotions are understood, the cycle continues. In the next section, we will look at real trading examples and practical situations where revenge trading destroys performance, and how disciplined traders break the cycle before it takes control. Now let us continue with some real trading examples. Imagine a trader who begins the day with a well-defined plan. Risk is controlled. The setup appears. The trader enters. Everything looks normal. Then the market moves against the position. The stop loss is hit. The loss is small. The account remains healthy. Nothing serious has happened. But emotionally, the trader feels frustrated. The trader begins replaying the trade in the mind. Maybe I entered too early. Maybe I should have held longer. Maybe I should have avoided the trade completely. Instead of accepting the loss, the trader becomes emotionally attached to it. A few minutes later, another market movement appears. The setup does not meet the trading plan. The risk is unclear. The probability is questionable. But the trader enters anyway, not because the setup is strong, but because the emotional need for recovery is strong. This is how revenge trading begins. Now imagine another trader facing the exact same situation. The loss occurs. The stop loss is hit. Disappointment appears. But instead of reacting immediately, the trader pauses. The trader stands up, takes a short walk, breathes deeply, reviews the trade objectively. Was the setup valid? Was risk managed correctly? Was the execution disciplined? If the answers are yes, the trader accepts the outcome. The loss becomes part of the business. The emotional storm passes, and discipline remains intact. This is how professional traders think. Now let us examine another example. Imagine a trader who experiences 3 consecutive losses. The losses are small. The risk management plan is working. Nothing unusual has happened. But emotionally, confidence starts decreasing. The trader begins thinking, I need a winner. I need to get back to break even. I cannot end the day negative. These thoughts create urgency. Urgency creates emotional pressure. Emotional pressure creates poor decisions. Soon the trader increases position size. The trader abandons the trading plan. The trader starts chasing price. What began as 3 controlled losses becomes 1 large, uncontrolled loss. The account damage comes not from the original losses, but from the emotional reaction to those losses. This is a critical lesson. Most trading damage is often caused by emotional decisions after losses, not the losses themselves. Now let us move into mental frameworks. The first framework is called process over recovery. Professional traders focus on process. Amateur traders focus on recovery. This distinction changes everything. When recovery becomes the goal, emotions dominate. When process becomes the goal, discipline dominates. After every trade, ask yourself, did I follow my plan? Did I manage risk correctly? Did I execute properly? These questions focus attention on behavior, not outcomes. And behavior is where long-term success is built. The second framework is called independent outcomes. Every trade is independent. The next trade does not know about the previous trade. The market does not owe you anything. The market is not trying to help you recover, and it is not trying to punish you. Every setup should be evaluated independently. This mindset removes emotional baggage. It prevents one loss from influencing future decisions. Now let us discuss another framework, the emotional weather framework. Think of emotions like weather. Some days are sunny, some days are stormy. A storm eventually passes, but making important decisions in the middle of a storm is rarely wise. The same applies to trading. When frustration is high, decision quality is low. When anger is high, discipline is weak. When emotions are intense, stepping away often becomes the smartest decision. The goal is not eliminating emotions. The goal is preventing emotions from controlling behavior. Now let us discuss practical exercises. The first exercise is the mandatory pause rule. After every losing trade, take a short break. 5 minutes, 10 minutes, even 15 minutes if necessary. The purpose is simple. Create space between emotion and action. Most revenge trades happen immediately after losses. The pause interrupts the cycle, and interruption creates awareness. The second exercise is the emotional scale check. After a loss, rate your emotional state from 1 to 10. 1 means completely calm. 10 means extremely emotional. If your emotional level is above 7, do not trade. Wait until the number decreases. This simple exercise forces honesty, and honesty protects discipline. The third exercise is the loss acceptance statement. After every losing trade, say the following. This loss was part of the business. This outcome was always possible. My job is execution, not prediction. These statements may sound simple, but they reinforce healthy thinking, and healthy thinking creates healthy behavior. Now let us discuss journaling. Most traders journal trades. Very few journal emotions. Start recording emotional triggers. What caused frustration? What thoughts appeared? What stories were you telling yourself? What happened before the urge to revenge trade? Patterns will emerge, and once patterns become visible, change becomes easier. Now let us discuss another important tool. Daily loss limits. Professional traders often establish maximum daily loss limits. Once the limit is reached, trading stops. No exceptions, no negotiations, no attempts to recover. This rule exists for psychological protection, not just financial protection, because emotional decision-making becomes more dangerous after losses accumulate. Now let us discuss confidence. Many traders try to build confidence through winning. The problem is that winning is unpredictable. Some days are profitable, some days are not. If confidence depends entirely on outcomes, confidence becomes unstable. Professional traders build confidence differently. They build confidence through discipline, preparation, consistency, execution. These qualities remain under their control. And because they remain under their control, confidence becomes more stable. Now let us discuss self-forgiveness. This topic is rarely discussed in trading. Many traders punish themselves after mistakes. They replay losses endlessly. They criticize themselves. They create guilt. The problem is that guilt often creates more emotional trading. Professional traders take responsibility, but they also move forward. They learn, adapt, improve, and continue executing. Growth comes from learning, not self-punishment. Now let us discuss long-term thinking. Revenge trading is built on short-term thinking. The trader becomes obsessed with today's result, today's loss, today's frustration. Professional traders think differently. They focus on long-term consistency. One trade does not define them. One day does not define them. 1 week does not define them. This perspective reduces emotional intensity, and reduced emotional intensity improves decision-making. Now let us move toward the final takeaway. Every trader experiences losses. Every trader experiences frustration. Every trader experiences disappointment. These experiences are normal. The difference between successful traders and struggling traders is not the presence of emotions. The difference is how they respond to emotions. The revenge trader reacts. The disciplined trader responds. The revenge trader seeks immediate relief. The disciplined trader seeks long-term consistency. The revenge trader focuses on recovering losses. The disciplined trader focuses on following the process. Remember this: the market does not require perfection. The market requires discipline. The goal is not avoiding losses. The goal is managing yourself during losses, because that is where trading psychology truly matters. The next time you experience a losing trade, take a breath. Review the situation objectively. Trust your process, and refuse to allow one loss to become many losses. Every time you resist the urge to revenge trade, you strengthen discipline. Every time you choose patience over urgency, you strengthen emotional control. Every time you follow your process despite frustration, you move closer to becoming the trader you want to be. If you found value in this lesson, subscribe to Bull Mindset. Keep developing patience. Keep strengthening discipline. Keep mastering your emotions. And remember, successful traders are not the traders who never lose. They are the traders who remain disciplined when losses happen. Thank you for watching, and I will see you in the next Bull Mindset video. Thanks for watching.